Today we'll be covering Directive 12. This is a directive that was issued by the board, and it is on the selection of an appropriate reporting framework by public entities. I think before I get into the requirements for Directive 12, I would firstly like to give you a brief background and history on the project. So with the promulgation of the New Companies Act in 2008, this led to the withdrawal of statements of GARP, which were previously issued by SAICA for financial years commencing on or after 1st of December 2012. So this decision meant that entities that applied statements of GARP could no longer apply these statements. As such, the board could no longer prescribe statements of GARP for government business enterprises, that is GBEs. So this issue was then, the issue that the board debated was what would be the appropriate reporting framework for government business enterprises, GBEs. Should they apply IFRSs or standards of GRAP? Now I'm going to take you through a brief history of the project that led to the development of Directive 12. So back in 2002, when the ASB was established, the board had to consider which entities would apply standards of GRAP. Now, the board came up with a list of entities that would apply standards of GRAP, but then it also determined that entities such as GBEs, because they were more profit-orientated, that they would apply statements of GARP. So this is now in 2002. And then fast forward to 2012, when this is now when the board initiated its research project to determine what would be the appropriate reporting framework for GBEs going forward. At that point in time, as the board was conducting its research, it then decided that until it has completed its research, that these entities would continue applying the reporting framework that they were applying. So that would be statements of GARP for some entities and IFRSs for those entities that had received an exemption from the National Treasury to apply IFRSs. As part of the research project, the board conducted interviews and workshops with relevant users and preparers of the financial statements of GBEs, and also at the same time it considered what was happening internationally. At the International Public Sector Accounting Standards Board, the IPSASB was also debating whether the definition of government business enterprises was appropriate. And although the IPSASB was busy with its own project on GBEs, the board decided that because the two projects served different purposes or had different objectives, that it would continue with its project, but would still monitor what was happening internationally. So the board finalized its research project in 2013. And the result of the research led to the development of Exposure Draft 124, which was the board's first initial proposals relating to the reporting framework for GBEs. Included in ED 124, the board considered three options, and the options were as follows: that all public entities should apply standards of GRAP. Option 2 was that the reporting framework for entities should be determined based on their classification in the PFMA schedules. And then the third option was to determine the reporting framework based on a set of principles. Now, the board concluded that option 3 would not be appropriate because it would not have enough time to develop these principles in a short space of time. The first option, being that all public entities should apply standards of GRAP, the board did consider it. However, it was not supported because the board was of the view that there will be instances when IFRSs should be applied as opposed to standards of GRAP when considering the nature of entities. And then option 2, the board considered option 2 to be the most pragmatic of the three approaches, in that it would mean that those entities that are listed in Schedule 2 of the PFMA, that is your major public entities such as your SABCs, your SAAs, that these entities would apply a specific reporting framework based on their classification in the schedule. So we had Schedule 2 entities. As I've said, these are your major public entities, and then you have your Schedule 3B. These are your national government business enterprises, and then you have entities that are listed in Schedule 3D, being your provincial government business enterprises. So the board's initial proposal, which favored option 2, was that your Schedule 2 entities would apply IFRSs, whereas your Schedule 3B and 3D GBEs would apply standards of GRAP. So as part of the comment that was received from preparers and users when Exposure Draft 124 was published for comment, the feedback that the board received was that a lot of the users and preparers were not in support of that proposal for Schedule 2 entities to apply IFRSs and for your 3B and your 3D entities to apply standards of GRAP. And the reasons that were given was that it is inappropriate for the board to actually consider this option because there are instances where entities have been incorrectly or inappropriately classified in the PFMA schedules. And the respondents noted that in the case where an entity is incorrectly classified in the schedules, this would mean that that entity ends up applying an inappropriate reporting framework because it has been inappropriately classified in the schedules. So based on the feedback that was received in ED 124, the board then deliberated its way forward and revised its initial thinking and came up with more proposals in ED 130. So ED 130, the board considered if uniform reporting should be applied. So that would mean that all entities apply one framework. As I'd indicated before, that the board had its reservations for all public entities to apply standards of GRAP. And the reason for this is that the board felt that, or the board believed that there are in fact cases where IFRSs would be more appropriate. So this is then ED 130, and ED 130 was the exposure draft of Directive 12. In the next few slides, I will be taking you through what the requirements are in Directive 12. So Directive 12 outlines the criteria that should be used by entities in order to assess whether standards of GRAP or IFRSs should be used. This criteria that the board has developed, it outlines when entities can use IFRSs as opposed to standards of GRAP. In developing this criteria, the board considered that the basis for selection of a reporting framework should be linked to who are the users of the financial statements, what decisions do they make when they look at information in the financial statements, and as a result, what are their information needs in respect to financial statements. Therefore, this criteria sets out or actually responds to situations where the information needs of users are best satisfied by IFRSs. This is then linked to the nature of an entity's operations and also its funding. The board has set out in the directive that the assessment should be done by each entity. Therefore, this is a self-assessment that needs to be undertaken by an entity in order to determine what the reporting framework will be. How do we go about applying Directive 12? So Directive 12 applies to those entities that do not already apply standards of GRAP. So what this means is that entities that are applying standards of GRAP will not need to consider their reporting framework. They will continue applying standards of GRAP because that is the reporting framework that has been approved by the board. This therefore implies that your Schedule 3A and 3A entities are excluded from the scope of Directive 12. So any other entities that are not applying standards of GRAP will therefore have to take into consideration the criteria set out in Directive 12 and apply it for financial years that begin on or after the 1st of April 2018. The board has, however, allowed entities to early adopt or to apply the directive earlier than 1 April 2018. The criteria to apply IFRSs is outlined in paragraph 11 of the directive, and it basically touches on three things. So an entity can apply IFRSs if it meets the following. A, if that entity is a financial institution. Then we have B, if the entity has ordinary shares or potential ordinary shares that are publicly traded on capital markets. Or C, its operations are such that they are commercial in nature and only an insignificant portion of the entity's funding is acquired through government grants or other forms of financial assistance from government. So in developing this criteria, this is what the board considered. So if an entity is a financial institution, and the board has defined what it means by financial institution in the directive. This is a financial institution as defined in the Financial Services Board Act number 97 of 1990. So if an entity is a financial institution, then it can apply IFRSs and does not need to consider the other two criteria. However, if an entity is not a financial institution, but in looking at its activities, its primary activities are to provide financial services to its clients or its members, including the management of deposits and investments, or it is in the business or its activities is to provide loans and credit as per the National Credit Act number 34 of 2005, then that entity would be considered a financial institution. The second criteria, which deals with equity instruments. So if an entity has issued ordinary shares or has potential ordinary shares that are publicly traded on capital markets, then that entity would apply IFRSs. And the reason for this is that the board considered the regulatory requirements in respect of equity instruments. So for instance, as part of the JSE listing requirements is that entities that have issued equity instruments that are traded on the JSE, that they need to provide their financial information in IFRSs. One of the things that the board considered in developing Directive 12 was whether it should not include publicly traded debt. The board considered the JSE debt listing requirements, and what it noted from there is that the JSE does allow an accounting framework other than IFRSs in respect of publicly traded debt. Now, the last criterion requires entities to apply their judgment, because entities would need to assess the level of funding that they are receiving from government in order to determine whether or not they are dependent on government for funding or financial assistance. And they also need to consider whether their operations are commercial in nature. Although the directive does not define what we mean by operations that are commercial in nature, it does, however, provide a description which goes as follows, that entities would need to consider whether their overall financial objective is to provide goods and services to generate profits. So in making the assessment, an entity must look at what is its overall financial objective. Are they there to provide goods and services to generate profits, or is their financial objective related to achieving certain service delivery objectives? So this directive would only cover those entities whose operations are commercial in nature. The directive also outlines certain instances or situations that entities must be mindful of. For instance, the existence of a competitive market will not necessarily indicate that an entity's operations are commercial in nature, because what the board did note was that there are actually entities that do not operate in competitive markets, but however they have been established to address a specific market inefficiency. So the existence or non-existence of a competitive market will not necessarily lead an entity to conclude that its operations are commercial in nature. In criterion C, as you will note, that there's two parts that must be satisfied. The first part deals with assessing whether or not your operations are commercial in nature. And you also need to assess whether an insignificant portion of an entity's funding has been acquired from government. Now I'm focusing on the second part of that criterion, which deals with the insignificant portion of funding from government. Now, in making this assessment, an entity will need to consider the size, the composition, as well as the complexity of its capital structure. So in effect, what entities need to do is that they need to look at their capital structure in order to determine what portion of their funding has been received from government. Now, by government funding, although there isn't a specific definition that we have provided, however, the board indicates that we are referring to direct funding from government. So any letters of support or guarantees, that would not be considered government funding. In making the assessment of how insignificant this funding is that you have received from government, you would need to consider the nature of the funding. By nature of the funding, we are referring to funding such as loans, capital injections, or even grants. You also need to look at the use of the funds. How do you intend to make use of those funds? So is it are the funds going to be used to sustain the entity's operations? Or are you perhaps involved in a special project that you are undertaking on behalf of government, whereby those funds will be used for that specific project? Or is it a once-off grant that you have received from government in order for you to sustain your operations? Or it could be a loan that you received from government to recapitalize the entity. And then lastly, what you also need to consider is the entity's level of dependency on the continued government funding. So what this means is that you need to consider how often are you getting government from funding? Is it an initial cash injection, or is it a recapitalization? Because these things will help you in assessing whether or not you are dependent on government, and to what an extent you are dependent on government. So these are three things that are important in making the assessment. Just to recap, as we need to look at the nature of your funding that you are getting, you need to look at how do you intend to use that funding, and then you also need to assess your level of dependency on the government funding. So essentially, when assessing your level of dependency, you would need to ask yourself the following. Is the entity sustainable without the funding that it receives from government? And you also need to look at the frequency or the timing of such funding. So how often does an entity receive the funding? Just to give an example of how you would go about doing the assessment. So if an entity receives once-off funding from government in order to be recapitalized, taking all facts and considerations, taking all facts and circumstances into consideration, one can see from the above that because this entity is only receiving once-off funding in order to be recapitalized, that their level of dependency on government is somehow limited. So they're not depending a lot on government for funding in order to sustain their activities. In another example, where you have an entity that receives funding, say, per annum, or in order to sustain its operations, for that entity, the level of dependency is quite high because that entity cannot sustain its operations without the funding from government. What's also important to note is that when you're making the assessment relating to paragraph 11 on the criteria that we have just covered, is that this assessment is a holistic assessment. So what that means is that you need to look at all the historical facts as well as prospective information in order for you to do the assessment. So what the board was trying to do, and the reason why the board felt that it should include this in the directive, is that the board did not want a situation where entities would be changing their reporting framework every year. So as such, this is not an assessment that is done at each reporting date, but rather it is an assessment that will be done initially on adoption of the directive, So when the directive becomes effective, that is on 1 April 2018, or if the entity is in a position to adopt the directive, then they will do this initial assessment to consider whether they can apply IFRSs or not. The directive also notes that there will be situations where entities may need to apply or do the assessment at a subsequent date as a result of changes that have occurred that result in the criteria no longer being met. So included in the directive, the board made provision for assessments that may need to be redone at a subsequent date. And the reason for this is that the board noted that there may be situations where significant changes have occurred that have resulted in the entity either meeting the criteria outlined in paragraph 11 or no longer meeting the criteria outlined in paragraph 11. So in such instances, then a subsequent assessment is warranted. When making this group assessment, you do it for the economic entity and not for the individual entities. So this therefore takes away the situation where you have entities within the group that are applying different reporting frameworks. So what's important is that it is the economic entity that will be assessed rather than the individual entities within that group. So I have taken you through the important requirements of Directive 12, when you are meant to do the assessment and how you are supposed to do the assessment. Now the last slide is just a snapshot of Directive 12, and it's really just to recap on what we have covered. So in this last slide, we basically give you a fact sheet on Directive 12. Who should apply Directive 12? As I've said, it is entities that currently apply IFRSs or statements of GAAP. So those entities that are applying standards of GREP are outside of the scope of Directive 12 and therefore will not apply Directive 12. The requirements of Directive 12 basically says that an entity would apply IFRSs if it meets one of the following criteria that is outlined in paragraph 11 of the directive. So if that entity is a financial institution, if that entity has publicly traded shares, if that entity has operations that are commercial in nature and an insignificant portion of funding is acquired from government. So that is the criteria that we have outlined in paragraph 11. If you meet the criteria, then you apply IFRSs. If you do not meet the criteria, then you will apply standards of GREP. When should entities apply Directive 12? As I have said earlier, that there will be an initial application or initial assessment that is done by entities when the directive becomes effective on 1 April 2018 or earlier if an entity is in a position to do so. However, the board has also made provision for situations where a subsequent application of the directive may be necessary. And this will often be the case where there has been a significant change that leads an entity to meeting or no longer meeting the criteria that we have outlined in paragraph 11. Now, I'm sure a lot of you are asking, so what happens to this exemption if I have an exemption from the National Treasury to apply a specific framework, for instance, IFRSs? The purpose of the directive is that entities can do this assessment. So basically everybody's starting on a clean slate. If you did have an exemption from the National Treasury, then that will no longer be applicable or that will no longer be valid. So an entity will still be required to make this assessment irrespective of the previous exemption that they had received from the National Treasury. In terms of the next steps, as I have said, that the effective date of the directive is 1 April 2018. So entities should be now making their assessment in order to determine what will be their future reporting framework. Thank you.